Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, October 14th, 2024. Economic activity last week reported actually was kind of negative for the market in that we had negative inflation data, and as well the employment data point that we got was worse than expected. So in particular, last week we had CPI and we had core CPI. And in both of those cases, the actual number came in higher than the expectation. So for core CPI, it came in month over month, a positive 0.3%. Consensus was positive 0.2%. And for the headline inflation number, it came in positive 0.2% with an expectation of positive 0.1%. Both of those were negative, clearly. Initial jobless claims. The expectation was 230,000. It came in at much higher level, 258,000. So those data points were on Thursday. Then on Friday, we did have the PPI number, which was okay, positive to okay, and the consumer sentiment number. In terms of the PPI, month over month, the PPI headline number was expected to be up 0.1%, came in at flat, 0.0. So that's good. The core PPI, producer price index, that came in exactly as expected, was expected to be up month over month, 0.2%, and it was. The Michigan consumer sentiment number also came in. That was worse than expected to come in at 70.8%, and it came in at 68.9%. So with those, you might expect maybe expectations for economic growth to be down, or the markets to necessarily be down, and neither were the case. So in terms of GDP expectations for the third quarter, now the quarter's already over. However, based on new information last week, the Atlanta Federal Reserve took up their expectation for third quarter GDP, which had been at positive 2.5%, took it up to an expectation of positive 3.2%. Inflation expectations. We show this chart most every week, don't spend a lot of time on it, and usually the movements are pretty modest, so no need to. However, last week we had a kind of significant rise in inflation expectations, but when you combine that maybe over the last 3 or 4 weeks, it's been a pretty big move. So we hit down almost to the 2% level in terms of 10-year inflation expectations. The 10-year break even, and that has now risen to 2.33%. So that's a somewhat significant move. So markets are thinking economic activity maybe a little stronger than expected. And so inflation expectations for the next 10 years have been rising. Now, in terms of what investors expect for the Fed funds, for the Federal Reserve and what they're going to do with interest rates, expectations have been coming down again for expectations for further cuts. We just had 50 basis points less than a month ago. Now the expectation for another 25 basis points in the November meeting. That the expectation at 84% is pretty much where it was just a week ago, but where it really changes is by the end of the year. So by the end of the year, the expectation of 3 cuts now is 0%. It was 7.4%. But a month ago was 41% probability of 3 rate cuts. So looks like we might get, at this point, 2 rate cuts through the end of the year. So that'd be 4 total, which is well below what anyone thought coming into 2024. So I've just given you the economic data points that we track from last week. You might reasonably expect equity markets to be down with that news. Maybe fixed income up, the reverse was true. So last week, S&P 500 actually up 1.13%, very solid. That was really driven by growth, sort of the first half of the year story. So growth was up 2.13%, value only up 1%. So solid week for the S&P 500 and better than both the developed market index, ex-US, and emerging market. So the developed market index ex-US was pretty much flat, up 10 basis points, S&P up 1.1. Emerging markets, however, gave up 1.68% last week. This has really been driven the last several weeks by changes that the Chinese government made that really pushed their stock market up. That unwound a little bit last week. China was down 7%. So the emerging market index, again, down 1.68% last week. Bonds, actually yields rose last week. And what we've been seeing is, and we kind of thought this might happen with the Fed pushing the short-term rates down, longer-term rates have actually been moving up. So last week, 2-year was up 4 basis points, but the 10-year was up 14 basis points. So the Bloomberg U.S. Aggregate Bond Index last week was down 46 basis points. Now, for the entire year, still a solid return to that index, that Bloomberg U.S. Aggregate Bond Index, up 2.93%, but just a couple of weeks ago, it was over 5%. So, U.S. S&P 500 up a very solid 23.25% on a year-to-date. Growth value, pretty much a push on a year-to-date basis. Large, however, significant increase or a lead over small cap returns year-to-date basis. And the U.S. markets, again, we'll just use S&P 500 as a proxy, strongly outperforming MSCI World ex-U.S., developed markets, and emerging markets. So that's it on the return side. Let's just take a look at some of the economic data that's going to be released this week. Really kind of starts on Thursday. We're going to have retail sales and retail sales ex-auto. And again, along those lines of the economy being stronger than most expected, expectations are being pushed up. So these numbers will come out for the month of September. In the month of August, the increase for both of those indexes, retail sales and retail sales ex-auto, was up 0.1%. For the month of September, retail sales expected to be up a very strong 0.3% month over month. Retail sales ex-auto, positive 0.2%. Initial jobless claims. The expectations now are higher than we had seen certainly 3 months ago, and really prompted last week's kind of large unemployment claim number. So last week was 258,000. This week we're expecting about the same at 255,000. The only other data points this week, both housing related, both on Friday, building permits and housing starts. Won't bother giving you the number, but bottom line is both of those for the month of September down just very slightly from what we saw in the month of August. So that's it for a recap of the economic activity and returns from last week. We thank you very much for your attendance. We'll look forward to seeing you next week. Thank you.